Alright, so you've got money to invest, but should you put it all in at once, or spread it out over time? This is one of the most common questions in crypto investing. Today, we'll compare dollar cost averaging and lump sum investing, the pros, the cons, and which approach might work best for you. Hi friends, welcome to the channel. Now I'm gonna level with you. I thought this video was gonna be really boring, so I was kind of dreading making it, but then I realized that this is actually super interesting and there are some nuances here that I am excited to share. So hang with me. First off, let's define our terms. What is lump sum investing? Well, lump sum investing means putting all your available capital into the market at once. For example, if you have $5,000 to invest, you just buy immediately, instead of breaking it into smaller amounts. The advantage: if the market goes up afterward, you maximize your returns. Historically, in traditional markets, lump sum often outperforms DCA because markets generally trend upward over time. But in crypto, things can get a little bit tricky. So what is dollar cost averaging? Dollar cost averaging, or DCA, means investing a fixed amount at regular intervals, regardless of price. For example, $100 every week into Bitcoin or Ethereum. The goal is to reduce the risk of bad timing. Instead of worrying about catching the top or the bottom, DCA smooths out volatility and builds your position steadily over time. Okay, so let's take a quick look at each one. Let's start with lump sum first. Let's review the pros and cons. Right. So the pros are, you get maximum exposure if the market rises. So if the price goes up, you're going to see the biggest return. Historically in bull markets, lump sum has higher returns compared to DCA. So based on past data, if you invest all your money in one go during a bull run, you're likely to make more than if you'd spread it out. It's simple. One decision, one action. When you decide to invest a lump sum, you just buy and then you're done. There's no more decisions to make unless you want to, change your asset allocation later on. But there's a big catch. If you invest right before a crash, you're stuck with immediate heavy losses. In crypto, where 50% drops are common, this risk is significant. So imagine this. You have $5,000. You buy at the top, and then the price drops by 50%. Suddenly, your $5,000 is worth half as much in terms of the value of coins you own. So now you have $2,500 worth of coins. That could be a lot, or it could not be a lot, depending on the price you bought at. But either way, you've taken a loss. And if you had used a DCA strategy, you would have avoided that immediate heavy loss. So let's talk about the cons of DCA. And there's a couple. First, DCA may have lower overall returns. So historically, studies show that DCA tends to lag behind lump sum investing, especially in bull markets. That's because when the market is rising, DCA means you're constantly buying less and less as the price climbs. And since you're not fully invested all the time, you miss out on some potential upside. Second, DCA requires patience and commitment. So with DCA, you have to stick to your plan no matter what. Even when you think the price is too high, you still have to keep buying. That can be tough, especially in a volatile market like crypto, where prices can swing wildly in short periods. Finally, DCA doesn't protect against permanent loss. So even though DCA helps you avoid losses in the short term, it doesn't mean you won't experience a permanent loss. In fact, if you invest in a coin that tanks and never recovers, you're still going to lose money no matter how much you invest or how often you do it. Okay, so now we've talked about the cons of both. Let's discuss the pros of DCA. First, DCA reduces emotional stress. So if you're new to investing, this is a huge benefit. You don't have to worry about picking the perfect time to invest or making a single big decision that might not pan out. And that's a huge deal. Next, DCA keeps you consistent and disciplined. So with DCA, you don't have to rely on willpower or make decisions when emotions run high. Your investments are automatic. And that's important because even experienced investors struggle with this. Think about it. How many times have you seen an insane price swing and thought, "Oh, I should have bought more," or "Oh, I wish I hadn't sold"? Those are classic examples of emotional trading, and they're costly. So DCA eliminates those decisions. It makes you consistent and disciplined, and that's huge for long-term success. Third, DCA protects you from big mistakes. So this is a big one. Imagine this. You have $5,000 to invest, and you decide to use DCA. You were going to invest $100 a week. Well, you've got 50 weeks to invest, right? So you're going to buy every week. But then one day you read the news. Maybe Bitcoin went down 20% overnight, and you panic. You're scared, so you stop investing. Guess what? That was actually a good thing. Because by stopping, you avoided investing a bunch of money right before a massive drop. And that mistake is very common. I've seen it happen again and again and again. People see the price dropping and they panic. They freeze up and they don't invest. And then the price starts to come back up and they feel like they missed an opportunity. And guess what? That happens all the time. So DCA helps you stay calm and avoid those big mistakes. And finally, in bear markets, DCA lets you accumulate more coins at lower prices, positioning you for the next bull run. So this is a great benefit of DCA. You don't need to worry about the price. You're just consistently buying and accumulating more and more coins over time. And when the price drops, you're able to add to your position. So when the bull market comes back, you're in a great position to ride those waves. Now, the key thing to remember here is that the market can stay low for a while. Just because you're DCAing doesn't mean you're going to get the best price right away. But over time, DCA should help you build a good average price. So which is better, lump sum or DCA? And the answer depends on your psychology and situation. If you're confident in the long-term trend and you can handle volatility, lump sum might suit you. If you believe that the market will keep going up, then investing everything at once could be profitable. If you value peace of mind and steady growth without worrying about timing, DCA is probably the better fit. If you find yourself constantly checking prices and worrying about whether you bought in at the right moment, DCA will probably help you relax. In fact, many investors actually combine the two. They put a portion as a lump sum and the rest as regular DCA. That way they get some of the benefits of both approaches. And listen, both DCA and lump sum are powerful tools. What matters most is consistency and discipline. Don't stress about catching the perfect bottom or the top. Instead, focus on building your portfolio with a method that fits your personality and your financial goals. For example, if you're young and just starting out and have a long time horizon, lump sum might make sense. On the other hand, if you're more risk-averse and prefer to play the long game, DCA might be a better fit. And whatever you choose, remember, past performance is not indicative of future results. No one can predict the market with certainty. So focus on your strategy, stay diversified, and stay focused on your long-term goals. And here's an additional bonus. The DCA strategy can also be applied to dollar cost averaging into cryptos. So if you're interested in learning more about that, click here to learn more about the DCA crypto investor. We offer a variety of plans to meet your needs. Thank you guys so much for tuning into today's video. Remember, the best time to start investing was yesterday. The second best time is today. Smash that like button and subscribe for more videos like this one.